Welcome to Perspectives I. In this video, we will discuss the 5 most common AML or anti-money laundering compliance mistakes. 1. An outdated risk assessment. If the risk assessment is left to exist without revisions or modifications, it will not offer any safeguards to the company's anti-money laundering program. Unrevised assessments may have modifications made in operations, but not necessarily in compliance. An outdated risk assessment could mean inadequate controls and/or procedures. It increases legal, operational, and reputational risks. It does not recognize emerging risks, such as cybercrime, for example, that can make the institution susceptible. 2. An inefficient risk assessment. A risk mitigation effort must be performed for any changes in the operation whenever we have new customers, products, services, geographies, or distributional channels, for example, to observe and analyze the risk presented during those changes. Look for vulnerabilities in the AML program with the new additions. Evaluate the impact the changes will bring to the enterprise-wide risk. Optimize allocation of funds to mitigate the new risks. 3. Being unaware of new regulations. New regulations can change the AML landscape, and internal controls must be optimized and updated or changed. New regulations may result in changes of policies and procedures. Unawareness of new regulations places the institution in legal, operational, and reputational risk. New regulations can be for other departments for the organizations, for example, but can result in potential risks for AML compliance. 4. Training solely on basics. If training is provided only with standard and basic topics, the organization will have employees that may lack skills to identify, prevent, and mitigate money laundering risks. Criminal organizations are constantly developing new money laundering methods. Understanding other industry risks allows employees and directors to develop the skills to mitigate risks in their industry. A well-trained employee can bring to the compliance department new ideas and risk mitigation concepts. 5. Concentrate only in analyzing transactions above the thresholds. Most of the transactions exist below transaction averages, but transactions below averages are rarely analyzed because they are determined as low risk. Many criminal organizations are transacting below thresholds to pass unnoticed while laundering their proceeds. Smurfing transactions below averages sometimes is more efficient and profitable for criminals.